أجمعين. Ladies and gentlemen, distinguished participants, dear colleagues, it gives us tremendous pleasure to welcome all of you to this public hearing event today, an advanced interaction stage with the Islamic finance industry and the broader circles of stakeholders. The second in a series of public hearings for today's standard, aiming to reach out to subject matter experts and practitioners worldwide on a very timely and essential issue, hyperinflation, that many countries have been experiencing for years, but it particularly surfaced more noticeably over the course of a few years back due to the many factors currently at play, including fundamental economic and political, at the very center of the global economy of present day. The public hearing on exposure draft of financial accounting standard financial reporting for institutions operating in hyperinflationary economies is conducted live via video conferencing, and participants can join us from different time zones worldwide. So we would like to welcome you again, and we really appreciate your keenness to join us today. We are also pleased to welcome one of our prominent and key partners, the State Bank of Pakistan, which supports this event. Mr. Ghulam Muhammad Abbasi, Director, Islamic Finance Policy Department, State Bank of Pakistan, will address you with a welcome note shortly. Historical perspective and a bit of a timeline might be orderly to begin with. In 2022 and earlier, IOFI Accounting Board considered the recent developments in certain countries that may indicate hyperinflation in those economies. The board, IOFI Accounting Board, thoroughly deliberated on the resultant Sharia issues in financial reporting in such economies by the Islamic financial institutions. After rounds of in-depth deliberations and considering the views of the IOFI Sharia Board's relevant committee on the observations, IOFI Accounting Board concluded that the application of the generally accepted accounting principles for hyperinflation was not deemed aligned with the IOFI financial accounting standards. Accordingly, the board, IOFI Accounting Board, took a resolution to develop on a priority basis a standalone financial accounting standard, FAS, on accounting and financial reporting by Islamic financial institutions in hyperinflationary economies or operating in hyperinflationary economies to be duly aligned with the IOFI conceptual framework for financial reporting and related Sharia guidance. In the meantime, and back then, IOFI Accounting Board advised the IFIs, Islamic financial institutions, which have adopted IOFI FASs as a reporting framework to continue preparing and presenting their financial statements without considering the effect of hyperinflation, till the time IOFI issues its FAS on hyperinflation. Ladies and gentlemen, distinguished participants, dear colleagues, the representative of our supporting partner, State Bank of Pakistan, Mr. Ghulam Muhammad Abbasi, is addressing you. Mr. Abbasi, the floor is yours.
Thank you, Mohammed. Am I audible, Mohammed?
I see.
Yes, you are audible.
You're
okay. Thank you. Assalamu alaikum, ladies and gentlemen. A very good morning to all the esteemed participants and distinguished guests here. It's with great pleasure and profound gratitude that I extend a warm welcome to each of you representing the various facets of the Islamic banking community, and to this momentum session, which is focused on the exposure draft, the IOFI accounting standard on the financial reporting for institutions operating in the hyperinflationary economies. I think today's gathering marks a significant milestone in our ongoing efforts to enhance the regulatory framework and standards governing the Islamic finance as we delve into the intricacies of the financial reporting within the hyperinflationary economies. I think it's a very timely initiative of the IOFI to work on the emerging standards, addressing the emerging challenges. On behalf of the State Bank of Pakistan, I express my sincere appreciation to the IOFI for their invaluable collaboration and partnership in advancing our shared objectives. IOFI, as we know, that is a kind of a beacon of excellence in the realm of Islamic finance, pioneering the development and implementation of the comprehensive standards, not only on the Sharia side, but also governance, accounting, auditing, and ethics side as well. And I understand that on every segment, IOFI currently is very much active and coming up with the guidance and the exposure drafts, and all the Islamic finance practitioners and institutions are actively participating in these on these exposure draft and giving their valuable input. IOFI's tireless dedication to harmonize banking practices on an international scale has not only elevated the standard of the industry, but has also facilitated great transparency, accountability, and also I think it also contributed towards the confidence and development among these stakeholders worldwide. At the State Bank of Pakistan, we recognize the pivotal role played by IOFI, and we already, in terms of the Sharia standard, the State Bank of Pakistan have adopted 30 Sharia standards, mostly related to the banking, because State Bank of Pakistan regulates the banking industry only, while we have got the separate regulator for the takaful and the corporate sector and the capital markets. So after that, we are actively working actually to adopt the remaining Sharia standard as well, while we also issued to the banks the guidelines that until the State Bank of Pakistan adopts the remaining IOFI Sharia standard, the banks use IOFI Sharia standard as the guidelines. While on the accounting side, we are actively working with the stakeholders to adopt the accounting standards, as well as we are also, while developing our Sharia governance framework, we consulted the IOFI's Sharia standard as well as the IOFI's governance standards while we issued our Sharia governance standard in the past. And we are currently in process of reviewing that Sharia governance standard and Sharia governance framework in Pakistan for the Islamic banks. And we are taking all the guidance provided in the exposure draft recently the IOFI have shared with the stakeholders. In the end, I once again say that today's session provides us with a unique opportunity to engage in collaborative dialogue, drawing upon the collective expertise and insights of the industry practitioners, scholars, and regulators. As we navigate the complexities of the financial reporting in hyperinflationary economies, let us leverage this platform to exchange knowledge, share the best practices, and chart a course towards a greater resilience and sustainability in the face of the evolving economic challenges. I extend my heartfelt appreciation to each of you for your participation and active engagement in today's session. Your contribution are invaluable in shaping the future trajectory of the Islamic finance, and I'm confident that our collective efforts will yield fruitful outcomes that benefit not only our respective institution, but the broader Islamic banking community as a whole. Once again, I extend a warm welcome to all of you, and I eagerly anticipate a productive and enlightening discussion ahead. Thank you.
Thank you indeed, Mr. Abbasi, for your invaluable remarks on the standard and IOFI adoption reality and status in Pakistan. And we really do look forward to that moment where IOFI financial accounting standards are considered for adoption there, in addition to other sets of standards. We also do appreciate the efforts exerted by the State Bank of Pakistan for supporting IOFI standards and the various activities undertaken by IOFI locally, regionally, and worldwide. Let me now invite to the virtual floor Mr. Omar Mustafa Ansari, IOFI Secretary General, who will present the exposure draft and walk you through its main content while interactively answering your questions and addressing your comments. All relevant comments and suggestions will be collected and presented to the respective working group to consider and make the changes it deems appropriate to the exposure draft. Mr. Omar Mustafa Ansari, over to you.
Thank you very much, Brother Majd. أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, my respected brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you very much, my dear brother Ghulam Muhammad Abbasi Sahab, for the support that you are providing as the institution as a person to the cause of Islamic finance in general and to the activities of AOFI in particular. Thank you very much, sir, for that. For today's public hearing, the topic of the standard is very unique, means that it does not impact all the economies and all the situations. Even under IFRS, the equivalent standard, that is IS 29, is also not adopted by a lot of countries. And even if it is adopted in a lot of situations, it doesn't apply. Because the first scope limitation for application of this one is that when you have hyperinflationary situation, which happens very rarely. While there have been I think there is some voice coming from the back end. Can we make sure that everybody's muted?
Yes, we'll make sure.
Okay, please. Thank you very much. So while in unique cases, this was still applicable, IS 29 in particular, in some of the countries. But the reality is that since COVID and after the world economy trying to revive from the shock that it got during the COVID times, a lot of supply chain challenges, lot of transportation challenges, lot of unemployment related challenges, and additionally a lot of how you would say that in the financial sector there had been inordinate delays in payments because of COVID, so that also impacted. So in an overall basis, there is a large number of countries since then that has been facing a high inflation, even if not hyperinflation. So maybe like, that pre-COVID times or during the COVID times when the interest rate in some of the benchmark interest rate in some of the foreign markets, particularly the Western markets, United States and others, was near to zero, under 1%. Like 0.25% in the US, if I remember correctly, and certain other countries, this was also less than 1%. Some countries kept it at 0% for some point of time as well. That started rising up, and it reached up to 6 and 6.25% in more of the developed markets, and some of the markets even beyond that. And for less developed markets, double digit was a minimum. We have examples like multiple examples. Now, this interest rate is one of the indicators. The benchmark interest rate is one of the indicators that all these governments have been trying to curb inflation, high inflation, or in some situations hyperinflation through this thing. Now, if we leave the interest rate data and we go to the inflation data, at times that is a bit less reliable in the markets, but still, if you see, there is a large number of markets, including Islamic finance related markets, that are into hyperinflation, irrespective of whether the accounting for hyperinflation has been adopted in those countries or not. So, for example, if we take the example of those countries, so the countries where Islamic finance exists and they are into a hyperinflation situation include Lebanon, Syria, Turkey, Sudan, Yemen, Iran, Suriname, some of the African countries, and there are countries, additional countries that were all exactly on the borderline of that situation. Bangladesh a bit less, Pakistan a bit more, and certain other Asian countries. And some other countries, although they were not into a real hyperinflation situation, but they also faced a significant high inflation situation. So considering, while for example, let's take an example for the GCC and Middle Eastern countries, which were probably not that much impacted, particularly the oil producing countries that were not that much impacted by the hyperinflation trend globally. But even with regard to the core inflation, they had something very high. even if you don't term it as hyperinflation. But since the oil prices were also high, hence these countries were at least able to control the inflation by providing subsidies, etc. Although even in some of these countries, the subsidies have been withdrawn either completely or partially in the recent years. So putting it together, the challenges related to hyperinflation that have been in existence for last 3 years since COVID-19, since the end of the COVID-19 regime, that period was slowed down, but even the economy is picking up and being on a faster track, still the inflation could not be controlled. And this is including the global challenges with regard to the supply chains, with regard to, for example, the certain food items, certain grains, and not only limited to this, even we have the issue of the silicon chips and other things that became slowed down and impacted the production and activities in different countries. I don't want to take too much time on this analysis, but just wanted to give you a picture that when we realized the need for this standard a couple of years back, the first issue that came to us was that there are a lot of Muslim countries having Islamic finance presence, or even other certain non-Muslim countries, but having Islamic finance presence, where in addition, we are having certain countries, whether they adopt AOFI or don't adopt AOFI, but somehow AOFI standard accounting is being impacted. So for example, it is possible that Bahrain is not into hyperinflation, but Bahrain-based certain Islamic financial institutions have presence in certain countries like Lebanon, Syria, Sudan, etc., or Turkey, where even if in some of them AOFI is adopted, like Sudan and Syria, and some of them don't adopt AOFI standards, but like Lebanon develop their own guidance based on AOFI. So it is almost AOFI-based guidance. But Turkey also puts AOFI standards as guidelines. But there are certain other situations where the subsidiaries of our banks located in the countries where AOFI standards are followed were not following AOFI standards. But still that challenge was there, that even if the parent is subject to AOFI standard and it's not subject to hyperinflationary economy, but its subsidiaries may be subject to hyperinflationary economy, which means that you cannot just stand up and sit down and say that, oh, we are not impacted by this. Effectively, the whole world was being impacted. And that was the reason that we started a study on IAS 29 and other available international guidance. And we realized that due to the unique business model of Islamic banks and financial institutions and certain challenges with regard to Sharia-based application of these, we felt that it is a challenge that we may not be able to apply IAS 29. So after some discussion with the Sharia committee, the board of AOFI accounting board decided that we should issue a statement that that IAS 29 or any other generally accepted accounting principles are not acceptable for the purpose of Islamic finance accounting. And this is where we started this project of developing our own standard. It has taken some time because a lot of thinking, thought process, and I would say while we are trying to align all our accounting standards with IFRS, and as I have been mentioning in our public hearings earlier, let me mention it again, that the accounting board of AOFI has a clear strategy that we do not want to develop any standards in over and above the international accounting standards, where there is no value addition. Now, how you define the value addition from our perspective is that either we have a specific Sharia issue, which is not addressed by the international accounting standards, generally accepted accounting principles in the way as we intend to have it. So, for example, if the Sharia do not allow you to combine two of the contracts in one, we cannot combine its accounting. That is our view. That is secondly, if, for example, the conventional accounting standards require discounting of receivables and payables, and for us, discounting of established receivable or payable or accruing or adjusting it to fair value is not acceptable as per Sharia, because as per Sharia, the established receivables and payables should always remain at sale value. So this is one situation. And the second situation is where the business model or the transaction structure of Islamic finance is different from the conventional. So while there can be similarities, but for example, in Islamic finance, we have a transaction which is based on bay or based on partnership. We cannot just treat it like a conventional transaction which is based on interest. And this is a situation where we have to at times follow our accounting treatment is still aligned with the IFRS, but the approach might be different. So for example, in Ijara standard of AOFI, we have the lesser accounting, which is aligned with the operating lease lesser accounting under IFRS 17 and not as per the finance lease accounting. And we have our reasons for justification for that part. So we still try to align with IFRS, and we try to apply the right and correct business model of the institution on the current structure of the transaction. I'm sorry I've taken some time on this discussion, which is a very conceptual and basic discussion, and most of you might be aware of it, but we need to understand this for the conceptual foundations of this standard, because this standard is slightly different from the not slightly, significantly different from the conventional standard on the area of hyperinflation. And the reason is, from our perspective, we believe that the Islamic finance accounting for hyperinflation should not have any compromise on the Sharia side and should take care of the business model of Islamic finance transactions and structures in an appropriate way. And that was the reason that we deviated in terms of this standard from IFRS or other generally accepted accounting principles. I have one question in the Okay, there is one question. Okay, let me just start sharing of the screen now, because now onwards we can share the screen and move ahead, and then we will take the first comment that we have received because it's on the introduction part. So I have provided you the brief background of the standard. I believe that my screen is shared with all of you now. So let me move with this. Now, I have given you the significant background as well as some introduction with regard to what we had, but I haven't discussed what were the unique significant challenges. So those I will be touching upon a little bit before going through further details of this one. So when we talked about the Sharia compliance part, we had certain challenges with regard to what values are accepted for the purpose of accounting by Sharia. So Sharia accepts fair values or market values as a primary basis, and Sharia accepts cost and amortized cost as acceptable basis of accounting in different situations. These all details are contained in AOFI's framework and AOFI's financial accounting standards that are addressing different types of transactions and structures. So from that perspective, what is the acceptance of Sharia with regard to the distribution of profit? What is the accepted policy for Sharia with regard to valuation of different assets and liabilities? All these things have some Sharia connotation. So for example, adjusting a established receivable or payable at a value other than its par value is not acceptable as per Sharia. That is our understanding, which is the way it has been reflected in our framework and different financial accounting standards. Similarly, there is a profit and loss distribution mechanism involved in Islamic financial institutions, particularly the Islamic banks, which involve certain concepts which are themselves very important. So you need to apply the right values to determine the profits and losses attributable, but you also have challenges with regard to the undistributable amount. So within the Sharia boundaries, there can be situations where the reserves, particularly the fair value reserves arising from revaluation of assets and assets, for example, sukuk or other shares and other instruments on the balance sheet, these are at time not which, if are not realized, are not distributable according to the contractual obligations or according to the regulatory requirements in different countries. Similarly, you can have situations where a constructive liquidation takes place on every month or every 3 months basis, which means that the amounts reflected there will not be adjusted. Similarly, there are subsequent measurement issues like our subsequent measurement of our quasi-equity. Quasi-equity is based on the my apologies. There was a call and I forgot to put it on silent mode. My apologies for that. So the quasi-equity subsequent measurement is dependent on the subsequent measurement of the underlying assets. So you cannot just simply adjust the values attributable to quasi-equity that have been appearing. So the issue of applying the revalued amounts as per IAS 29 or any other conventional accounting standard that addresses, and the literature that addresses these situations may not have faced the challenges with regard to Sharia and business model that we have faced. And considering all of these things together, we got a challenge on an overall basis. I would say that can the overall basis of accounting and the generally accepted accounting principles, IFRS, etc., can be acceptable for Islamic finance? And we had long discussions on these points and trying to find solutions that can be there. While we have tried to find some solutions in the form of this exposure draft, but I can tell you and I can assure you that your comments are very much valuable for us, particularly for those who are already working in hyperinflationary economies, or for those who are just at the verge of having a hyperinflationary economy, considering that what we are trying to approach is a sort of significantly new sort of ideas in respect of some of the accounting aspects. Again, when we say new sort of ideas, it does not mean that these ideas are new in accounting. The point is these ideas are new for the purpose of creating a standard to be applied in the situation of hyperinflationary economy. So some of the solutions that have been provided may have their own basis in respective OFI phases or in generally accepted accounting principles or IFRS, etc. I'm sorry I've taken a lot of time in the initial discussion like this without going to the standard, but I think and I hope that this will be quite helpful as we go through the discussions. So we will highly appreciate having your comments and an interactive session. Just a request, everybody, please put the questions and answers on the Q&A tab. I saw a few things on the chat window, but in the Q&A tab, there are two questions. The first one is from Mohavi Ismail. Assalamu alaikum and welcome. Thanks for issuing the standard. It's an exposure draft, not yet the final standard. Introduction, the name of the standard is not mentioned. It is not good to insert the name of the standard in the last line of line 4 of the last paraphrase, which is this topic. It is just about the writing style. Thank you very much for your comment. This is just about a writing style. In earlier standards, some of the standards we used to write this thing in the introduction part, but now in some of the standards we have written like in the introduction one that this is standard, and in bracket we mentioned the standard name. But probably it was like, the writing style was changed on some comments received from the board and others, that the name of the standard is not necessary here. We take your comment and we'll see what is the right approach. Thank you very much. However, the name of the standard appears in the beginning and in the header of the document itself anyway. Thank you very much again for your comment. We have comment from anonymous attendee, and as I request every time, I request you to kindly put your name as well, because it is and I would request everybody that whenever you join, you can rename yourself as your original official name, plus if possible also mention the name of the institution. So it helps us in ensuring that we capture the comments properly and we are able to understand the background and of the comment as well, considering the institution name. At times it helps us in understanding the specific situation in different countries as well. So anyway, just a request that please please try to put your name when you put out a comment. Anyway, all the comments are still captured, but coming from anonymous attendee wouldn't enable us to understand the background of the person who is actually raising the concern or raising the question. Okay, it is from Brother Latif from Capital Market Authority from the KSA. Thank you very much, Brother Latif, for mentioning your name. If you can kindly rename yourself, because it is quite possible that there might be another anonymous attendee as well. But for this one, we are going to mention your name in record purposes. Thank you again for your kind attendance and being part of this today's discussion. Will the change of a functional currency from a hyperinflationary to non-hyperinflationary become a free choice? It's an excellent question, actually. It's a very good question, Brother Latif. So while you have put this question a bit early, because we haven't gone to the approaches that are discussed in the standard, but number one, I highly appreciate that you have read the standard before coming with depth and raising a very good question is highly appreciated. So our answer would be that hyperinflationary economy, we are giving a specific one-time choice for change of the functional currency. This raises a question in my mind additionally. For non-hyperinflationary economy, for sure, we are not giving this option as a common option unless the functional currency actually changes due to certain reasons. But for this one, I think there is one question that has come up to my mind now, and that is that what happens when you move back from hyperinflationary to non-hyperinflationary economy? Means that when the application of this standard is suspended. So while this standard is applying a choice of applying a different functional currency in the event of a hyperinflation, what happens towards the reversal? So the question first answer to the basic question is that are we going to allow change for non-hyperinflationary economies? No, generally it's not a free choice for sure. Even in case of hyperinflationary economy, there are certain conditions of hyperinflationary economy which also evidence that there might be a change in functional currency. And we have used that analogy to allow a change in functional currency part. But I think your comment generally raises some of the questions that need to be addressed maybe. Number one, whether it's a one-time choice or whether it's a choice that can remain available for multiple times. That is number one. Number two, what happens if functional currency is changed and then there is a hyperinflationary economy cease to exist and then you have to revert back to the normal accounting? So what happens in that situation? Whether you revert back to the normal functional currency that was there before that, although the situations may be different in different countries considering these things, like, with some situation, these things may become a norm. And even after reverting from hyperinflation to normal inflation in normal economy, it might still not be changing back the functional currency to the original currency. But I think that that something might need to be mentioned about the reversal part, because the reversal part with regard to the normal accounting we have addressed, but the reversal part with regard to the functional currency change probably has not been mentioned in the standard. So thank you very much for a very good comment. I think two things we need to address here coming from your comment. Number one, whether is it a one-time choice? Number one. Number two, would AOFI be still considering the factors that are determined for the purpose of hyperinflationary economy having a functional currency change? Would it be applicable on the normal currency as well or not? That normal situation as well or not? Number two. Number three, what happens when it reverses? Thank you very much for raising one good question that opens up certain debates in different areas. I think that we might need to address it in the standard or basis of conclusion, but it surely needs to be discussed in the working group and the board. Thank you very much, Brother Latif, again for a very good comment. And let me move to the next question now. It is from Shinov Shaib. What is, and again, my apologies as people join us from so many different countries and regions. At times the names are new or not familiar for us, and if I like mispronounce any name, my apologies in advance for that. So really apologies if I'm not pronouncing it properly. What is the difference between IAS 29 and financial reporting for operating in hyperinflationary economies? I have touched upon some of the things, but the main difference I'm going to mention briefly going forward. Brother Mustafa Abu Bakr has joined us again. Thank you. Welcome, Brother Mustafa. Assalamu alaikum. Please, will there be a recording of the webinar sent? Brother Mustafa, all our AOFI public hearings on public hearings on different standards that we do through Zoom, they are always being available on the YouTube at the same time, and they are available on this YouTube for the time for later times as well. You just need to approach AOFI channel on YouTube to have access to this and other public hearing recordings. Even the earlier recordings which were not there on YouTube, we have requested the team to make sure that all the earlier public hearings are available. So in the times to come, inshallah, you all will be having access to a huge amount of information through the public hearings, roundtables, conferences, seminars, that ever are conducted on a hybrid form. They are all available on YouTube. Conferences, video recordings, even if they are, although they are on Zoom as well, and are live broadcasted on YouTube, and hence they are also available. You just need to access to the AOFI's YouTube channel, and probably you will be able to find a lot of data on that. Thank you very much. Okay, so now we move to the main body of the standard. The objective of this standard is to establish the principles of financial reporting for the institutions applying AOFI financial accounting standards operating in hyperinflationary economies, duly considering the relevant Sharia principles and rules and their unique business models. Scope. The standard is applicable to the institutions preparing financial statements in line with the requirements of AOFI FASs, whose functional currency is the currency of a hyperinflationary economy. This standard shall also be applicable on consolidated financial statements of the institution to the extent that to the extent of impacts relating to a subsidiary or subsidiaries whose functional currency or currencies is the currency or currencies of a hyperinflationary economy. Definition of a hyperinflationary economy. Just let me clarify one thing, that definition of hyperinflationary economy here is not part of the, it is part of the scope. Means that this definition is important to understand the scope itself. A hyperinflationary economy is an economy wherein money normally denoted in terms of currency of that economy loses purchasing power against assets, goods, and services at such a rate that impedes the meaningful comparison of financial reporting in respect of transactions and events that have occurred at different times, sometimes within the same financial reporting period. This definition is improved definition by AOFI. Now, there are factors for determination of hyperinflationary economy. While these hyperinflationary economy factors are similar with IFRS, we have made some minor changes or improvements to that, because the accounting literature generally available, including IFRS, has certain uniform factors. The factors generally remain the same, except for some of the improvements that we have made in our situation. So determination of a hyperinflationary economy in line with the definition provided in paragraph 4 is highly subjective and hence cannot be performed by applying a fixed or predetermined criteria. Nevertheless, any or a combination of the following factors may lead to a conclusion that an economy is hyperinflationary. A cumulative inflation rate over a 3 years period has exceeded 100% or is approaching the same with an increasing trend. Now, this is there are two changes in this one as compared to IFRS, and we would like to have your comment on that. The first thing is that this is the first criteria now, because an IFRS, this is the last criteria, but effectively this is the only criteria. So we know that under IFRS, the countries that are adopting IFRS for hyperinflation, they are also having mainly this criteria, 100% inflation over a period of 3 years. But we made it slightly improved that number one, we have put it number one. And secondly, we have said it is exceeded 100% or is approaching the same with an increasing trend. So exceeded or approximating, this is the point. So let me give an example. So let's take an example of a country where it has exceeded 100% for 3 years. So the origin, instead of approximately 100%, so what happens if it is 99%? What happens if it is 98%? So the first condition is not approximating, but rather it has to exceed 100% in 3 years, which means that 33, 33, 33, but again, it's a compounding and cumulative inflation rate. So even the compounding effect is included in that one. But cumulative inflation rate, we are talking about 100%. So 3 years, 100% inflation has happened, which means that the meaningful comparison of financial information is no more there. Now, when we use the term as approaching the same with an increasing trend is very important. So if it is 99%, you don't apply it. We are saying that if with an increasing trend it is reaching 100%, then it should still be considered as hyperinflation. So for example, first year you had 33%, second year you had 33%, third year you had 33%. It is a consistent trend, not reaching 100%, but approximating 100%. This is just one example which will be very judgmental. Now, for example, first year it is 40%, second year it is 30%, and third year it is 25%. It is not an increasing trend. Rather, there is a trend that although it is just approaching 100% over a period of 3 years, still the trend has started going down. So if it has exceeded 100%, you will still have to apply it. But if it has not exceeded 100% and it is approaching 100%, but without the increasing trend, you may still not apply it. So if you are at 95, 98% without increasing trend, probably GM Abbasi Sahab might be happy to hear that in case of Pakistan, although again, you have to adopt our standards to be closer to Sharia and all that. But as of now, I think Pakistan is an example that it has nearly reached 100%, but probably the trend has started decreasing now. So maybe for those countries where the situation has started at least to improve, the application of the standard would not be required. Benchmark discount rate, wages, and prices are linked to an index. Prevalent use of the stable foreign currency in place of functional currency. This is item number C. I will just ask you to keep in mind that item number C, D, and I think F. C, D, E. C, D, and E are very important. So prevalent use of a stable foreign currency in place of functional currency. Prices are usually quoted in stable foreign currency. General population prefers to keep monetary assets in a foreign currency. So we can see situation in a lot of countries where US dollar, euro, or another stable currency is basis for pricing of items. So even the normal accounting and all these criteria are going this way.
Brother Amar, you are muted.
Okay, my apologies. There was some disturbance here. So can you hear me now? Okay.
Yes.
Okay. So general population prefers to keep monetary assets in a foreign currency, stable foreign currency. So three situations. Number one, pricing, prevalent use of foreign currency, prices, quotation in foreign currency, and population used to convert monetary assets in foreign currency. These are the three situations which we will discuss later, which are also situations of hyperinflation, but they may have an indication of actually a change in the functional currency of the respective country. And that is why we have come up with a different solution to which one of the question was raised as well. General population prefers to invest in non-monetary assets and keep minimal amounts of monetary assets. Notwithstanding the factors enumerated in paragraph 5, an economy may be declared to be hyperinflationary by a multilateral institution or the respective central bank of the respective government. Sister Noof and Sister Sarah, please make a note on this footnote. See ED of of control of asset and business. I think it is about ED of phase on. But now even that standard is final, so I think we need to update the footnote, please. Okay.
Oh, okay, no, noted.
For the purpose of interpreting and applying this standard, the following short definitions are relevant. Fair value. Now, this is important because fair value definition is similar, but there is a specific context here as well. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date and in the specific context of this standard, and for the purpose of application of paragraphs 15 to 17 also include deemed fair values as prescribed in this standard. So the difference is that in the specific context of this standard, deemed fair values are also included. Now I can see there are a couple of questions again, and let me take those questions. This is comment from Brother Muhammad Putra Aprullah from the Institute of Chartered Accountants, Indonesia. Thank you very much, Brother Muhammad, for being with us. Islamic accounting conceptual framework is very important to be developed. Global financial accounting standards straight line with the development of Islamic financial instrument coherent with the framework of sustainable finance. Islamic financial system can be solution to global financial instability due to hyperinflation. The question is how to force Islamic financial institutions to comply confident with apply Islamic financial accounting standards consistently and harmoniously with international accounting standard. Thank you very much, Brother Muhammad. What you have said is absolutely, you have spoken up of our mind, and it is very important with the that the global Islamic finance and Muslim countries, accounting bodies, and the regulators work together towards establishing a framework like this. AOFI is trying to do our part of this, and we have seen, and we are very much we are very much aware of the fact that Indonesian Sharia Accounting Standard Board has also done a great job. We have been collaborating with the Indonesia Sharia Accounting Standard Board in past as well, and we would love to have more collaboration with the Indonesia Institute of Chartered Accountants as well as with the Indonesia Sharia Accounting Standard Board to work on this part. For all other parts of the world, we are trying to work at our end. Thanks to the Central Bank of Pakistan for being with us today and all the central banks and the regulators who are working with us. But I think you have spoken very important thing. It's not only about this standard, but it's also about the overall basis on which the financial accounting should be done. Again, while a lot of things can be aligned with the IFRS, and that is what we are trying to do as of now, but still there are unique characteristics of Islamic finance. There are unique characteristics of the Islamic legal and trade system, which all need to be incorporated into the accounting standards and the overall framework. So thank you very much, Brother Muhammad, and we are already doing our part. And I would suggest that we should have more collaboration between the bodies, that is the Indonesian Sharia Accounting Standard Board and the Institute of Indonesia Chartered Accountants. So we would love to have a better collaboration, for which I would request our team to contact with you to have better coordination going forward, and you can connect us to the right people with whom we should be having more discussions for collaboration. Thank you very much. Brother Muhammad Bilal Zafar has raised a point that in addition, the IMF publishes inflation forecast. Applying the indicators read out in IAS 29, the following economies should be considered hyperinflationary for the purpose of applying IAS 29 and for retranslation of foreign operations in accordance with IAS 21 effect of this as per 2023. Argentina, Ethiopia, Ghana, Haiti, Iran, Lebanon, Sierra Leone, Sudan, Suriname, Syria, Turkey, Venezuela, Yemen, Zimbabwe. I hope you will be considering this criteria as well. If you see, Brother Bilal Zafar, if you see, we have used the term and by the multilateral institutions. If you just see in paragraph 6, we use the term. So we were talking about the World Bank and IMF data for that purpose, that obviously the central bank is the direct body, that central bank and the respective government is the body to determine the right inflation rate. But that is the reason that we actually mentioned about the multilateral institutions as well. Brother Bilal Zafar, we have kept an eye on all these countries, and there are more countries, even under the IMF report, there are more countries who are close to that or approaching that. Those included countries like Pakistan as well. So from that perspective, we have kept all of this in our understanding and discussion. I can tell you that Lebanon does not adopt officially IS 29 on this part as well. Turkey does not adopt IS 29 as well. But what is happening that the countries, the institutions and companies who are having their subsidiaries in these countries, they are doing it. There is one Islamic bank in Suriname as well, and we took their input as well with regard to as to how they apply and what challenges they have been following. But Turkey, the institutions in Turkey and Lebanon are not applying it. Sudan is in last couple of years in a very bad state of affairs with regard to the political and the civil war type situation. That is why, while Sudan is one of the important players for EUFI, and we have a lot of members there and they adopt all our standards, but our contacts with the central bank and the other stakeholders are a bit weak. But for sure, we have applied the moral. But just one thing to clarify that IMF criteria for this one is also based on the same 100% inflation, cumulative inflation over a period of 3 years. So, so we have not mentioned any names of the countries or anything. We just have established the criteria. But generally, if I try to put in a summary, that generally our view is that all of these will be applying. If you see those which are having Islamic finance out of these are important, because Ethiopia is starting Islamic finance, doesn't have it. Argentina doesn't have it, but Ghana has started something. Iran is almost all Islamic finance. Lebanon has Islamic finance also, although not that big. Sudan has all Islamic finance. Suriname has Islamic finance. Syria has significant Islamic finance. Turkey has Islamic finance. Yemen has Islamic finance. And if you see that Yemen, Turkey, Syria, Sudan, Lebanon, they all adopt EOFI standards in one or another form. Like Lebanon does not adopt directly, but adopts through making local regulation. Turkey has put our standards as guidelines to be applied, and it's like adopted by both the accounting regulator and the financial sector regulator. But the situation is that a real life application is not there. And from our perspective, obviously, this standard is yet exposure draft and it will not be finalized. So we've not seen any significant examples except for the Suriname one that I mentioned, that they have applied IS 29 and applying in developing and financial statements for the Islamic Bank. So sorry, I have taken a bit more time on answering this question, but this is very important to understand that from our perspective, we have countries which are subject to this risk as of now and will be subject to EOFI accounting. And for some of them, even if they are not following EOFI standard, but some of the parent institutions in the EOFI standard adopting jurisdictions have investments in some of these countries. So this is a huge challenge. Only thing is, although this standard is in process for 2 years nearly, and the exposure draft was also issued more than nearly a year back, but we can see that in some of the countries the situation is getting better, particularly the countries where it was approaching 100%. Some of those countries probably might not be having 100% plus situation now. Still, they are subject to very high inflation, but not hyperinflation. And please understand that there is high inflation we haven't defined, but in general terms, the public is talking about a very high level of inflation. But till the time it does not reach 100% cumulative over a period of 3 years, we don't call it hyperinflation, or unless other factors are not met that are defined in this standard, or for example in IS 29. So let me move back to the definition. So hyperinflationary is defined already. Index is the means of quantifying the periodic effect of weighted aggregate pricing, purchasing power, or performance of economic resources. In the specific context of this standard is the means of quantifying the periodic effect of weighted aggregate lots of purchasing power of a currency against economic resources that are against a basket of stable foreign currencies. Investment pool is a virtual entity, at times a separate reporting entity comprising of distinct assets whose risk and reward wholly or proportionately are attributable to the funding provided by the respective quasi-equity investors. Sister Saira and Noof, just make a note of it that we might need to recheck that because the standard on quasi-equity is now final. So we might need to recheck the definition, particularly it may be by not only by the respective quasi-equity investor, but other set of participating stakeholders as well. So maybe we just need to see it.
Yes, Brother Omar, actually we put a comment on the respective standard for this particular definition. We will come back to that maybe towards the final stage. Okay. There was a comment.
Okay, thank you very much. Measuring units at the end of the units of the currency having a currently prevailing value at the end of financial reporting period or is indexed at a given point of time in line with the requirements of this standard. Monetary assets. Now, monetary assets are from Sharia perspective at times defined differently. So we are saying that in the specific context of this standard are assets that are in the form of cash, contractual right to receive cash or another monetary asset from another institution or entity, or contractual right to exchange a monetary asset with another institution or entity. Monetary liabilities in the specific context of the standard are the liabilities expected to be settled in determinable amount of money, fixed amount of money. Now, coming to options, we have two main options. Okay. If you are into if you have identified that you are into a hyperinflationary situation, then you have one of the two options. First is you redetermine your functional currency in line with the provisions of paragraph 9 or follow the fair value based accounting according to paragraph 10. So these are the two main options. So if you are in hyperinflation, either change your functional currency, or which is for us, the functional currency change is an out-of-the-box solution and it provides answer to a lot of challenges. And otherwise, you follow the fair value-based financial reporting requirements according to paragraph 10. Paragraph 9 says where a factor or combination as enumerated in paragraph 5C, 5D, and 5E exist, and there are no legal or regulatory restrictions. Now, this is the problem. If you talk about one country, normally the country regulation does not allow you to prepare financial statements in a different currency. And that is why we have mentioned that if there are no legal or regulatory restrictions to the contrary, an institution shall consider as to whether a redetermination of functional currency and reporting currency to a stable foreign currency is appropriate in line with relevant EOFI phases. In such a case, the institution shall follow the requirements of relevant EOFI phases. The option 2 is that elements of financial statement of an institution whose functional currency is currency of hyperinflationary economy shall be restated according to the requirements contained in paragraphs 11 to 29. So now we have not discussed too much about the foreign currency part, but I think that the comment raised today by Brother Latif was very important. So I think we should be considering certain additional guidance either in the body text or in the base of conclusion of the standard, in a way that at least some of the aspects are covered there with regard to the functional currency part. Now coming to the fair value part. And here we will try to understand what are the difference with IFRS. So first difference, as I mentioned, main difference is that IFRS does not give you a choice of changing the functional currency, but we are proposing, again, it's a draft standard exposure draft. We cannot say that we have provided, but in a nutshell, we can say that our standard provides a basis for this, that you can have a choice of change in hyperinflation, change of functional currency and reporting currency if there is no regulatory requirement in the event of hyperinflation. However, that is, we still believe that that will not be applied by majority because of the legal restrictions. So what majority need to do? So, statement of financial position. An institution whose functional currency is the currency of hyperinflationary economy shall remeasure items constituting the elements of its statement of financial position at fair value, with the exception of accounting treatments prescribed in paragraph 12 to 13. Now, let's understand why we are talking about fair value. We believe that fair value and the current value, first thing is IS 29 does not require you to remeasure the items which are at current value, which might be fair value or net realizable value, depending on the situations. So from that perspective, if you are already on fair value, then you don't need to restate things for the current year balances. We'll come to the comparatives later. So if I can have my financial statements all on the basis of fair value, there is no hyperinflation accounting separately required. You got my point? That hyperinflation accounting is required when it's not fair value, but it is the cost value, amortized cost value, or other basis of accounting which are not reflecting the value which is current of current date. Why? Because the fundamental concept is that hyperinflation makes the financial statement not comparable on a entity to entity basis or period to period basis. So the first accounting principle, and if you can apply this one without any exception, it can become ideal. But there are exceptions, and the exceptions have their own justification. So first thing, what are the exceptions? A, monetary assets and monetary liabilities. Now, this is an exception for fair value, but it would not be an acceptance from IFRS, because from IFRS perspective also, anything that is equivalent to cash and convertible to cash is not adjusted, but not all of it. Some of them might need to be adjusted, but the point is, as of the balance sheet date, what is the current value at which you need to establish the monetary asset and monetary liability? So if the monetary asset and monetary liability as of the balance sheet date are to be adjusted at the same value, it is equivalent to their fair value as well, technically speaking. And additionally, they are not required to be like revalued under IFRS as well, because this is the value at you settle them for cash. So you receive cash or you pay cash, but this is the value. That is the reason that we have kept it as an exception to be fair valued. Secondly, from our perspective, Sharia standpoint, you cannot readjust the value of established receivable or payable. So for us, these values are, from Sharia perspective, not allowed to be measured at a value other than the par value. So for us, it's a Sharia requirement, but it doesn't create a huge difference from IFRS. B, assets acquired for future delivery for which a contract or promise exists requiring delivery sale at pre-agreed, pre-promised value. So IFRS also talks about some of the indexed situations, but here there is a situation clear that although we may have a different value, for this asset today, if we had tried to assign a value properly, but from the perspective of settlement, what value it is going to be settled, if we have a pre-promised or pre-agreed value, we will not be adjusting it, because if you adjust it today, then you, for example, you book a gain today. I purchased an inventory for 100, and its indexed value might have gone to up to 120, but I have a promise to sell it at least at 110 already. So it should be measured at 110 and not at 120, because if I book at 120, then later I will have to book a loss again. So the better and appropriate thing is that if I have an expected amount of recoverability in cash and I know how much cash will be recovered against it, so I should simply keep it at that value, which is the pre-promised or pre-agreed value. Held to maturity investments in sukuk and similar instruments reflecting a fixed or virtually fixed stream of cash flows. Now, according to IS 33, there are certain or majority of the sukuk that are having a fixed or virtually fixed stream of cash flows, which are allowed to be kept as amortized cost, or you can keep them at fair value through income statement or fair value through OCI. Now, the point is that if you have these at fair value through a held to maturity investment, you have kept them at amortized cost. So the point is that this situation will result in accounting mismatches over a period of time. So you start adjusting the values now. You put it at fair value. The fair value may be downward in most situations. So you end up recording a loss, because it's a fixed stream of cash flow coming up. Considering the values, the situation, its value, because the cash flow is coming over a period of time, its value may go significantly down. But the point is that today you book a loss, tomorrow you book a gain. I can see a question in the Q&A tab by Brother Sayyid Imtiaz Abbas Hussain. Assalamu alaikum, brother, and welcome. If a product which price to say is rupees 122.21 need to pay Pak rupees in 133, 22 and need to pay 133 in 23, even in 24 it needs to pay for 33. How your standard will consider the situation as 100% cumulative inflation or 133%? No, it is not 100% cumulative. 100% cumulative will be that in 3 years you become 100 to 200. If it is not 100 to 200 in 3 years cumulative, it's not. So the effect will be when actually its value goes down, goes up from 100 to 133 in first year, then 167, 68 in second year, and 202 or 3 in 3 years. Then it becomes like 100% cumulative inflation. So thank you very much, brother Imtiaz Hussain, for your question. And I believe that it is clarified clearly. So held to maturity investments have an issue, and not only this, the problem is if you put them at fair value, it may end up in losses. Those losses may result in huge banking sector impact because the banks have huge instruments like this. Now, what is happening that one thing you should understand, let me clarify why this will impact big time. In the high inflations, discount rates go up. Do we agree? So it means that if the instrument is a fixed instrument for fixed value instrument for some time, and its rate of return was like, for example, 15%. Now the market discount rate has gone up to 20%, 25%, 30%, 35%. What happens that the instrument loses its fair value and loses its fair value big time, which means that unless it's an instrument linked with the current value, the variable rate and discount being discounted being changed, and even as per Sharia, it cannot be kept open-ended. So as per Sharia, there have to be a floor and cap. So even if you say that it is a variable rate return, there is a huge probability that the cap will be hit, which means you cannot go and match the market rate of return, which means that your value of investment will go down. Now, this in value of investment going down is going to create a huge impact on the organization's overall basis. While considering the nature of the instrument, this has been created as a specific exemption based on some discussions in the working group and the board. We would love to have specific comments on this point from the regulators as well, even because regulators might be like, having a risk factor on this part. So if held to maturity investments, which are at amortized cost, we all know that held to maturity investments are at amortized cost. If they are there is a huge probability that there will be losses. Now, those losses will start reversing over a period of time, because the monetary value adjustment and monetary value reverse payment will be the same, which means that we book a loss today and we book a reversal tomorrow. And this is which may have impact on the regulatory capital requirements and the market, huge impairment losses in the markets, having losses being passed on to the investment account holders, while the instrument is not in an impairment situation, but the impairment comes only because of the market interest rate effect, not because of the default effect. So considering all these situations, we have proposed that these should be exempted from this requirement. Assets and liabilities linked by agreements subject to Sharia principles and rules to changes in prices. So anything which is subject to an index or a price change of price with or without caps and floors will be according to that, according to that, and quasi-equity. Now, at what value these are to be accounted for? So monetary assets, monetary liabilities, held to maturity investments, and assets acquired for future delivery for which a contract or promise exists requiring delivery sale at pre-agreed pre-promised value to be reported at carrying value in line with the requirements of relevant OFI phases. Assets and liabilities linked by agreement subject to Sharia principles and rule to changes in prices such as through an index with or without caps or floors reflected at values adjusted in accordance with the respective agreement. Quasi-equity, I mentioned earlier about this issue as well, that quasi-equity, that unrestricted investment account holders or sukuk, which are based on the underlying assets, they should be reflecting the appropriate effects of fair value adjustments to the underlying assets and related liabilities where applicable, either through allocated profits or losses or through creation of appropriate reserves. So for the quasi-equity, you do not revalue it directly, but rather quasi-equity is valued at the effect of the underlying assets. So the value of underlying asset, if they are in gain, if they are in loss, whatever appears, it has to be reflected in the quasi-equity. And that's why quasi-equity is exempted from direct accounting based on hyperinflation, but it will be impacted by accounting based on hyperinflation because of the adjustments in values. Now we have challenges about the determination and estimation of fair value, and here the concept of deemed fair value will also come in. The items of the statement of financial position of an institution that do not meet the exception criteria specified in paragraph 12, except for the transition effects as described in 42-44, shall include the following. So, Brother Mush, there should be a comma after 44. Please make a note of it.
Noted.
Assets and liabilities, if any, that are carried at fair value in line with their respective accounting policies to continue being reported at fair values in line with respective accounting policies, whereby the respective gains and losses to be reported accordingly. Assets and liabilities, if any, that are carried at cost or amortized cost in line with their respective accounting policies to be reported at fair values determined in accordance with this standard, whereby the respective gains or losses on fair valuation are to be reported as part of net hyperinflationary fair value gain or loss. So this is the equivalent of net monetary position. In IFRS, you have the net monetary position gain or loss. So here we have a reserve for the we have a reserve on the of the net hyperinflationary fair value gain or loss. So this will go there, being an item of other comprehensive income. So it will be routed through the other comprehensive income. Assets that are carried at lower of cost and net realizable value to be reported at the net realizable value, being an estimate of fair value only in the specific context of the standard, whereby the respective gains on fair valuation to be reported as a part of net hyperinflationary fair value gain or loss, being an item of the other comprehensive income, and the loss to be reported in line with respective accounting policies. Assets that are carried at the revaluation model amount. Just Brother Maj, there's something just coming to my mind. Just make a note of it. What about the reversal when the inventory is sold? I think we have kept quiet on this point. Maybe we need to provide some explanation to that part. Okay. Assets that are carried at the revaluation model, revaluation amount less accumulated appreciation and accumulated impairment to be reported at periodically revalued value, at least at the end of the financial year. The resulting gains or losses shall be recognized based on the respective accounting policy. All other assets or liabilities should be reported as deemed fair values estimated through application of an index in line with the requirements of paragraph 15 to 16. And again, Brother Must, I think we should mention that all the net difference will go to the hyperinflationary reserve. I think here we have not mentioned this thing, that the impact will be going to net hyperinflationary fair value gain or loss. Okay. Now, coming to deemed fair value, it may be impracticable for an institution to ascertain fair values of certain assets or liabilities due to unavailability of observable data inputs to assess the fair values of these assets or liabilities, or due to undue cost and effort inevitably to be incurred in ascertaining fair values. When the conditions described in paragraph 15 apply only in the specific context of the standard, an institution may apply an index to the balances of such assets and liabilities to obtain a deemed fair value. So this is similar to IFRS, but the difference is that IFRS makes it a restated or revalued amount, and we are considering it as a deemed fair value amount. For certain assets and liabilities whereby the fair value estimation in line with requirements of paragraph 11 to 14 is performed at the end of a financial period, the requirement of paragraph 15 and 16 for determination of deemed fair value may still be applicable for the purpose of valuation of such assets or liabilities at the end of the interim financial reporting period if the impact within such period is considered material. So for those items where you do an annual fair valuation, for periodic accounting, that is interim period accounting, you still need to apply the indexed value. Selection and use of an index. In line with the requirements of paragraph 16, an institution may be required to use an index that reflects changes quantifying the periodic effect of weighted aggregate price, purchasing power, and or performance of economic resources. It's preferable that this index is the same index as used by other institutions that report in the currency of the same currency or the economy. It means that if possible at the government level or the regulator level or the accounting regulator or accounting body level, our index should be established and agreed. However, it's like, as far as practicable, it is preferred that they all use the same index. For the purpose of this standard, an index may comprise of a general price index or a basket of general price indexes, that is the normal one, or index based on a basket of a stable foreign currency. This is not the common practice across the globe, and some of the practical constraints are there, because of which this is considered to be a better requirement. If I remember correctly, it is not allowed by IFRS. But I think that in some of the situations, it actually provides a better situation. And we came to know that certain in actual application of IS 29 also is done based on the stable foreign currency index basis. An institution shall assess the appropriateness of the index based on the type and classes of assets according to that, and the provisions of apply on the restated amounts, especially in case of application of paragraph 16. So the impairment, credit losses, and owner's commitment will still be applicable as per FAS 30 when paragraph 16 is applied. In the statement of income and comprehensive income, the current financial reporting period shall not be restated at the end of the financial reporting period. This is a difference from IFRS. IFRS requires a periodic adjustment, like they do a weekly or monthly adjustments based on index for all the values. Here we are not requiring this one. We are saying that it shall reflect the actual revenues and expenses that were incurred and recognized. This is, we believe, is a Sharia requirement, that profit and loss distribution to the investment account holders and profit and loss distribution to the shareholders and other participating stakeholders is to be based on the actual liquidation and actual settlement of amounts, which is a Sharia requirement. And that is why we are not asking, or we are not requiring, or not allowing readjustment of the current period financials in terms of income statement. Gain or loss arising on remeasurement. Net gain or loss for the period arising due to application of paragraph 11 shall be recognized in the statement of other comprehensive income. The resulting item shall either be subsequently accumulated as a distinct hyperinflationary fair value reserve, categorized and represented separately, representing the owner's equity and the quasi equity respectively, or comma before respectively. Brother Must, make a note of it, please. Presented as allocated profits or loss, distributable or non-distributable in case of profit. So, so it depends on the situation, but depending on the what has been defined in paragraph 11, I think it is paragraph 12 should also be referred, because okay, no, it is about the balance sheet statement. Okay, done. But I think it should be read with the paragraph, Brother Mash. I think we should create a cross reference on this one also, that it should be read with this paragraph 11, 12, paragraph 13 also should be referred. Okay, because paragraph 13 is specifying about some of the items where the reserve goes.
Okay.
So we should simply say should be read with paragraph 13 also. Paragraph 11 read with paragraph 13. Okay. The resulting item shall either be, I think this one we discussed. The standard does not require any adjustment of the statement of income and attribution related to quasi equity, except for reflecting the appropriate effects of fair value adjustment or adjustments referred to in paragraph 13 to the underlying assets and related liabilities where applicable. The effects of such assessment shall either be accounted for through allocation of profits or creation of appropriate reserves, including where applicable, hyperinflationary fair value reserve in accordance with the respective accounting policies. This standard does not require any adjustment to the cash statement of cash flows. Consolidated financial statements. Restatement in respect of subsidiary operating in hyperinflationary economy. A parent institution whose functional currency is the currency of a hyperinflationary economy may have subsidiaries that also have functional currencies being the currencies of a hyperinflationary economy. Alternatively, a parent institution whose functional currency is not the currency of a hyperinflationary economy may have subsidiaries that have functional currencies being the currencies of a hyperinflationary economy. The financial statements of any such subsidiaries need to be restated by applying the provision of the standard to the balance sheet, to the balances before they were included in a consolidated financial statement issued by its parent institution. With such a subsidiaries preparing its financial statements in a currency that is different from the functional currency of the parent institution, its restated financial statement shall be translated applying only the closing foreign exchange rates. I think there are a couple of questions coming up now. There is Brother Abu Salah Khilab. Okay, he just has mentioned his name. Thank you very much, Brother Abu Salah Khilab, for joining us. Thank you very much for your for your contribution and support to OFI. Brother Sayyid Imtiaz Abbas Hussain has another comment. Nowadays, Pakistan is facing near hyperinflation situation and chances for economic betterment are not possible in this realm of affairs. The bank balances in Pak 10 billion and its fair intrinsic value now is to say 5 million because, for example, 10 units of product was PK rupees 100 and now to pay for Pak 200. What bank balance of Pak 10 million or 5 million will be reported in the balance sheet under AOP standard? Brother Imtiaz Hussain, if it is AOP standard or IFRS, either situation, if you have cash, the cash means only cash value. Cash value does not change. So although cash purchasing power is going down, so what is happening that cash value is the same while the other values are being adjusted, which means that the intrinsic value of the currency, the purchasing power of the currency is going down. But the cash balance is not required for any adjustment. So for example, let me give an example just to try to explain. While we agree that this has happened, but would it be good to restate today's 100 as 200? No. But now there is a question for the comparatives. What happens to the comparatives? And there I'm going to come in my standard discussion now. So what happens to the comparative, Brother Imtiaz? That is important. So if I have 100 in the balance sheet date, it means I have 100, irrespective of what I can purchase out of it. But if I had 100 at the end of the last balance sheet date as well, it is possible that 100 was having a purchasing power of 140 or 150 as compared to today's 100. This is the question where IFRS requires the restatement of comparatives, and this is the situation where we might actually need to have comparatives. So thank you very much for your question. Let me move ahead, and probably this part of the comparative will be answered in the upcoming section that we are going to discuss. The financial statement of a subsidiary that has functional currency not being the currency of a hyperinflationary economy are dealt with in accordance with the respective OFIFAS. And when financial statements at different period ends are consolidated, this standard shall apply to all balances at the date of consolidated financial statements. Now, restatement of investee institution. An investee that is accounted for under the equity method may have functional currencies being the currency of an hyperinflationary economy. The statement of financial position and statement of comprehensive income of such an investee are restated in accordance with the standard in order to calculate the investor's share of its net assets and profit or loss. When the restated financial statements of the investee are expressed in foreign currency, these are translated at the closing rates. Economy ceasing to be hyperinflationary. When an economy ceases to be hyperinflationary and an institution discontinues the preparation and presentation of financial statements prepared in accordance with the standard, it shall treat the amounts reported in line with the requirements of the standard at the end of the previous financial reporting period, at the end of the carrying amount and subsequent financial statements. Brother Maj, this is the point where I think we need to just clarify, because now I realize that the fair value accounting is still paragraph 29. It means that paragraph 30 will be applicable on the change in functional currency model also. We just might need to provide some explanation in the base of conclusion, because till paragraph 29 we have reference for the fair value model. Till 30 means that 30 applies on all type of situations. So it means it apply on the functional currency change also. So I think that issue is already addressed. Only thing is that we might need to provide an explanation. Now coming to presentation and disclosure. In addition to the presentation and disclosure requirements of phase 1, unless contrary to any specific requirements of the standard, the institution shall include the following. The fact that institutions' functional currency is the currency of a hyperinflationary economy, and it has followed the requirement of the standard for the purpose of preparation of financial statements. The fact that the financial statements are based on fair value based financial reporting under hyperinflationary circumstances for the current period, and the corresponding figures, see transitional progression in paragraph 44, with additional disclosures of indexed comparative figures for the previous period. So this is the point that we are asking for two comparatives. Okay, that is comparatives and index comparatives. The identity and level of the price index at the end of the financial reporting period, and the movement in the index during the period and the previous financial reporting period, and the amount of net hyperinflationary fair value gain or loss for the period presented in the statement of comprehensive income arising due to application of paragraph 11, that is allocated as profit distributed to the quasi equity and allocated as profit or loss attributable otherwise to the owner's equity. Brother Majd, I think here also we should say paragraph 11 read with paragraph 13. Okay. The amount of the accumulated hyperinflationary fair value reserves, see also paragraph 35, that is attributable to the quasi equity and the owner's equity. The amount of net gain or loss for the period disclosed according to the paragraph 331D1 shall be classified between the amounts that are distributable and non-distributable. Now, let me explain this thing, because we talked about this thing that some of the things will be taken to reserve and not distributed. Why they will not be distributed? Because at time distribution is not possible. So what happens that if my fair valuation adjustment or the indexation adjustment based on the redeemed value is increasing the value of assets in my balance sheet. So I am having gains. But what happens to those gains? Are they always distributable? In some situations, these gains will not be distributable because they are still stuck with the assets. So if I am having gains on the fixed assets, if I'm having gain on the investment property, if I'm having gain on some of the inventories and other assets, the problem is till the time I don't realize them in cash, I cannot distribute them. So in the hyperinflationary economy, we should understand that this is one of the biggest challenges, that all of the gains may not be distributable. While it has to be dealt in accordance with the contractual and Sharia requirements and the regulatory requirements which are there, but we understand that all amounts will not be distributable. So we are saying that what is distributable as per policy and what is not distributable as per policy, contractual obligation, etc., should be clarified clearly. Particularly in some of the Sharia boards, they normally do not prefer to distribute the unrealized gains or losses. While AOFE allows in some situation unrealized gains or losses can also be distributed, but it is dependent on the individual Sharia board approvals as well as on the approvals of the as well as on the contractual obligations. So according to that, some of the unrealized gains or losses may not be distributable because in that situation you will have liquidity shortages. It is not workable at all. And particularly if you have investment property, fixed assets, you cannot just go and distribute those amounts. And the problem is, even if you distribute all those amounts, what happens that you will not be having enough capital for the next cycle. This is also an important challenge, that if you distribute cash, then your cash liquidity situation will go down with every cycle, and eventually you will have constraints on conducting the business itself. So from those perspective, it is very important that the distributable and non-distributable are kept in accordance with the regulatory, Sharia and contractual requirements, and these are appropriately disclosed as to what is recoverable and not. Now this takes you to the next level, that some of these reserves will be reversed over a period of time. So for example, there are reserves related to inventory, there are reserves related to investment property. So I intend to sell my investment property after 2 years. So it means that huge gains will become from undistributable to distributable after 2 years. So my investment account holders, my shareholders should be aware about this information, that if there are undistributable reserves, they are going to be reversed over a period of time. And accordingly, the hyperinflationary fair value reserve shall be classified between the balance that is expected to be recycled to the current statement of income in accordance with the regulatory and contractual requirements, as well as Sharia principles and rules, categorized into the amount payable within the next 12 months, between the next 1 to 3 years, and after 3 years. And the balance that is not expected to be recycled to the statement of income, like some of them, like, for example, fair value reserve on the fixed assets might always remain there. And even if it is released, it is not released to the income statement. In respect of hyperinflationary reserves pertaining to quasi-equity, including investment account holders and other participatory stakeholders, an institution shall disclose the expected periods of reversal or distribution thereof in accordance with the regulatory and contractual requirements, as well as Sharia principles and rules. The institution shall disclose the plan about utilization of the balance of hyperinflationary reserve that is not expected to be recycled to the statement of income. Then we have requirements about accounting policies. The institution shall disclose new and amended accounting policies as a result of application of the standard and their respective impacts, including in particular the accounting policies related to accounting for and recycling where applicable of the hyperinflationary fair value reserve and its attribution to and the classes of owner's equity and quasi-equity. We have a point from Brother Sanjeev Srinivasan. Can you share the key differences between IAS 29 and AOFE through email? Okay. I think we don't have any single document for that. Brother Must, I think because some other people asked for it, can you just make a quick, internally, can we do a short project to identify all the key differences between IAS 29 and this exposure draft? I think it's an important point. Some other people earlier asked as well. So I think we need to do it on a priority basis. So may I request you and Sister Saira to do it on a priority basis, try to identify all the key differences. Some of these things are not noted in our roundtable agenda that was there in the because we did roundtable on this one also. So the roundtable agenda also has some of the key differences identified. But I think based on the actual standard and the exposure draft of this standard, we need to work on this one. Thank you very much, Brother Sanjeev. I think it's an important point, and you are welcome. But we'll try to do it as soon as possible, and we'll try to make it published in some form. Maybe we will either publish in our journal or we'll publish on our website. We'll let you know, and we'll share one copy with you as well. So, Brother Mike, please make a note of it that we need to share it with Brother Sanjeev as well.
Yes, sure.
Now, coming to the corresponding and indexed comparatives. I touched upon this thing in the beginning of the disclosure related part. So what we are saying is that there will be three columns. So the first column will be the corresponding figures for financial statement, which will be as previously reported. So except for if there is a change in accounting policy, anything as per FAS 1 that will be changed, affected like normal. So the first set of the corresponding figures will be normal. Now, why we are asking it to be normal? Because the constructive liquidation was done for the investment account holders, because the value of receivables and payables, which are in monetary terms, cannot be changed as per Sharia, because the profit and loss distribution resulted in constructive liquidations, which resulted in the value determination for quasi equity, which shall not be changed as per Sharia. So considering these factors and certain other factors that I have touched upon, we have required that the main corresponding figures will not be changed, except for if there is a change in accounting policy and restatement as per FAS 1, not because of the effect of hyperinflation, but maybe another accounting standard being adopted or any other change in accounting policy requiring a FAS 1 adjustment. So it will be more or less as per what was exactly reported last year. Then there will be a third column. An institution shall additionally present a third column representing the index comparative figures by applying an index to the corresponding figures in line with the requirements of paragraph 18. So the index comparative will be indexing everything on the balance sheet. It will not be requiring a back-end accounting. You don't do the accounting and you don't do the adjustment of all the comparatives and all that, which is required by IAS 29. Rather, for us, the comparative accounting is different from IAS 29. IAS 29 requires you to do all the indexation from the back as well. We are saying your corresponding doesn't change because as per Sharia and unique business model, it will not be appropriate to disturb the figures that have been reported. That we cannot change, and that was the reason that we cannot adopt IAS 29 so easily for Islamic finance. However, in order to have a meaningful comparison only for the purpose of understanding of the user of the financial statement, and that is like the question from Brother Imtiaz Abbas Hussain, that like this year I have 100 in my cash balance. What was the worth of that cash balance of 100 last year if it was indexed? So the third column of the indexed comparatives will be provided, which will be actually providing a comparison of this situation. Brother Majd, again, there is a situation that this 38, 37 apply for the fair value accounting model, but not on the functional currency change model. So I think only paragraph 30 that we were talking about was more relevant, was relevant for the functional currency change. Okay.
Yeah. Yes.
Yeah. Okay, then index comparative figures shall be computed in the following manner. In respect of balances reporting in the statement of financial position by applying the changes index from the date at the end of the previous financial reporting period and the end of the current financial reporting period. In the respect of items of financial statement other than balance reported in the statement of financial position by applying the changes index from the date or week or month as practicable of the respective transactions to the end of the current financial period. So the comparative income statement, OCI, etc. will be changed the same way IFRS is changed. But this is for the third column of index comparatives, not for the second column. Second column remains exactly the same. We have suggested an effective date of 1 January 2026, but considering that some countries are already in this situation, we have suggested that it is preferable that they should follow. They may be applying early. It is encouraged. And additionally, it is suggested that all the institutions in one country, one jurisdiction should be applying the standard on the same day. Brother Sanjeev has provided his email address, so I would suggest that our team may kindly note it. Brother Rahil Bhagar has a question, and welcome, dear Brother Rahil. Assalamu alaikum. Would we please share the document with us as well? Brother, this is the same standard. So a standard is already available. May I request all the colleagues, because this presentation we normally don't share, the standard is in for PDF form is already available at a few website for download. May I request Sister Noof, Sister Hora to put a link to the exposure draft on the actually the Zoom invitation that you receive might also have a link to the document. But what I suggest that please, sisters, if you can just put it in this one. Okay, you are talking about IS 29 and this standard. As soon as we do it, inshallah, we'll do it. Inshallah, we'll share it with Brother Rahil as well. Thank you very much, Brother Rahil. But again, I'm not committing anything immediately. It may take some time. Our team is quite busy, but I'm requesting the team to do it on a priority basis. I'll prefer that document should be available before the third public hearing. There will be one more public hearing in English and one public hearing in Arabic for this standard as well. So I suggest that if that document is available, it will help in the public hearing as well. And obviously, we'll share it with the participants today and anybody who requests it. And additionally, we may publish it in the journal as well as make available on the website. So thank you very much. I think we have reached the end of, yes, transitional provisions are there. Sorry. Yes, Brother Maj, please.
Once this English version of the document is developed, do we need also to convert it into Arabic and share with the public?
Yeah. Before public hearing, it will be good. Before public hearing, at least we can discuss it in the Arabic public hearing as well. So we discuss it in the English public hearing and Arabic public hearing as well. Okay. I'm sorry, there were a couple of transitional provisions. Let me quickly go through them before we close the today's discussion. Notwithstanding the requirements of Phase 1, the application of this standard shall be a modified retrospective basis without restatement of corresponding figures and taking the cumulative effects in the opening retained earnings and reserve effecting from later of the beginning of the annual financial reporting period in which the institution concludes the economy is hyperinflationary in nature, or beginning of the annual financial reporting period in which this standard is adopted for the first time. So this is a transitional provision, making it a bit easier. Retrospective basis without, as provided in 42, without restatement of corresponding figures shall not preclude the institution applying the requirement of paragraph 38 and disclose the additional columns of indexed comparative figures for the previous period. And application of modified retrospective approach according to paragraph 42 shall disclose the appropriate adjustment for attribution to quasi equity. The disclosure shall be in accordance with the requirement of paragraph 31E. So to be honest, it's a quite complicated standard, very, very complicated standard. We have received another comment. Okay, again, this is about Brother Muhammad Al-Iraqi asking for the document. Surely, if the document is ready, we'll try to share it with you, all of you. May I request, Sister Saira and Hora and Bench to work on a fast track with this one and discuss with Brother Harun as well, as he was part of this important integral part of this project. So let's try to come up with something for the benefit of the participants. So now we have, I have been trying to be a bit quick today. But we have now a bit time available for any question that is still there. Otherwise, we can conclude. I cannot see any question here. And since the time is enough, if anybody want to raise hand and want to speak, that is also possible. For obviously not enough time, but a bit of time can be allocated to that. I don't think we have any hands raised as well. So with that, I think, Brother Maj, I hand it over back to you because there is no other question. So thank you very much, everybody.
Thank you indeed, Brother Mr. Mustafa Ansari, IOFI's Secretary General, for the insightful and comprehensive presentation of the exposure draft and the answers provided to the participants' questions and comments in today's public hearing session. In conclusion, we would like to extend sincere thanks to all our valued participants from across the Islamic finance industry and the broader stakeholders. for having taken part in today's public hearing on the exposure draft of the newly issued the standard financial accounting standard on financial reporting for institutions operating in hyperinflationary economies. Your comments and suggestions are essential for us in AOFI in improving and fine-tuning the exposure draft for finalization of the standards by the accounting board for final issuance. As I mentioned at the start of this session, all relevant comments, suggestions will be compiled and presented to the respective working group to consider and make the changes it deems appropriate to the draft. Public hearing, two public hearings we have still in the series of public hearings will be held shortly, inshallah, on the same exposure draft later in the year. A word of appreciation goes to all the participants, to the State Bank of Pakistan representative, Mr. Ghulam Muhammad Abbasi, and to all our stakeholders who have valued guests and valued participants and stakeholders who have joined us today. And also a word of thanks goes to AOFI's staff and secretariat team who helped make this event a success. Thank you all, and see you next time in the future public hearings on AOFI financial accounting standards. Thank you very much. Allah bless you all. Assalamu alaikum wa rahmatullahi wa barakatuh.
Assalamu alaikum.